So I'm going to go ahead and pass the mic back over to Tom so that he can present for us.
Right. So I need to share my screen, correct?
Yes, please.
All right, I'm going to get it going right here. See if that works correctly. How does that look?
That looks great. Thank you.
Excellent, excellent. Well, let's get started. I'm with the OneAZ Wealth Management team and would like to go over a number of things. I'll do a little introduction of myself here in a moment, but just for some compliance purposes, wanted you to know that we actually are presenting this presentation as educational and informational only. It is not intended to be any legal, tax, or investment advice directly to any individual. If you're looking for individual advice, we're more than happy to meet with you or talk with you on a one-on-one basis. But clearly, we're here to provide some great education, some great concepts that you can take from here and do it on your own, or you can go out and seek counsel from anyone that is properly licensed and equipped to do that for you. So wanted to give you that little reference. Also, if you'd like to connect with OneAZ Wealth Management directly, I'd like you to know you could check out our QR code here. That takes you directly to our website. And on our OneAZ Wealth website is lots of information, from videos to articles, calculators, even investment commentary that we have on our website for use. And it is an open public website. Anyone can access it. So I urge you all to use that or to reach out for more information. You can also reach out to us directly at OneAZ Wealth for any individual questions that you have. If you'd like to meet with one of our advisors, we'll make that available too. All of our advisors meet with our members on a complimentary basis, on the initial basis. So we'd be happy to meet with anybody that would like to have that kind of consultation. All right. Okay. So let's get started. The presentation that I'm going to be doing today is how to build your own wealth plan. My name's Tom Mitchell, and I happen to be the leader of the OneAZ Wealth Management team located here at the OneAZ Credit Union. You can reach me by my email address or even connect with me on LinkedIn. We are a group of 8 advisors with LPL Financial is our broker-dealer. And we are making all the different non-deposit investments and insurance products available to the credit union members of OneAZ. And we'll reach out to the general public. But more importantly, it's to anyone that would like to have access to great education, great counsel, and help them make a difference in their financial lives. So let's get started. First, I'm going to talk about a number of things tonight. First, I'm going to go over the OPM method. I'm going to talk about the 5 key components of a wealth plan. I'm going to talk about how do you measure up? How do you compare to others? And also, so I want to make sure there's some key takeaways that you'll have for tonight. All right. So let's first talk about this OPM path. This OPM path is OPM. What does it really mean? Well, the first is the O. The O means we'd like you, as any individual, to make sure you organize your financial data and you organize your goals. So as you start down any wealth management or any wealth growing plan that you'd like to develop your wealth, you need to be thinking about, how do I assemble my assets together? How do I know what my goals are? What are my objectives? So that begins the planning process. So through the O, it's getting all that organized. That's the first step. The second step is the P. The P is planning and projecting. Planning and projecting various scenarios of what we might be able to do, what you might feel comfortable in doing with your investments so that we can achieve those goals. And then lastly is that following up, that monitoring and managing the process. It's very, very important to be checking in on an ongoing basis, whether it's once a year, twice a year, whatever it might be. You need to make sure you're managing and monitoring where you're going. And if you notice, it's a circle. So it constantly is evolving, and clearly it's going to be changing as you continue to age. You're going to have different goals, different objectives at different stages in your life. So hence, your OPM plan will also be needing to be changed and addressed as well. Okay, let's start talking about some of the real basics. And maybe some of you have seen this before. And I'm reminded by the Egyptian pyramids, right? They've been around for centuries and centuries. They've been around because they're stable. They have a strong foundation, a lot of basic strength, and a lot of logic in that engineering of how that pyramid was built. Well, we can apply that same concept when it comes to investing. And what I like to call out here is looking at a foundation of your financial pyramid is very important, because once you build your foundation, and what am I talking about here? I'm talking about savings. I'm talking about money markets and life insurance, and really just having a good, strong foundation so that you can then start to look at investing, and you look at different styles and different risk levels. If you notice, the pyramid goes up and it goes from conservative growth all the way to the top being speculative. And the speculative is the most risky. And sadly, some people think they can jump right up into the top. Well, the most important thing is to make sure you have a foundation, and then you gradually grow as you continue to amass your assets and your wealth. You start to build and you start to go up the different levels of the pyramid. So I always like to use this illustration, and many times I'll even put in the client's assets in looking at where they are in that pyramid. Are they top heavy, or are they too bottom heavy as well? It's so important to have a good, strong pyramid so you have a good wealth plan overall. Another thing we like to do is take a look at the three pockets. The three-pocket analysis is taking a look at where you have your assets during certain periods of time and your needs, okay? And their pockets, meaning short-term would be that less than a year, mid-term is 1 to 5 years, and then the long-term is beyond that. So let's use an example of Casey. Casey actually has some short-term needs. She has a birthday party she's planning for. She also has some dental work she needs done. So she needs to make sure, or he needs to make sure, to have assets set aside to meet those needs at that stage in their life. So that's 1 to 12 months. Then when they get into the midterm, they may have a family reunion. They may have a new car. They may even have a kitchen remodeling they might want to think about doing. Those things need to be thought of and planned in that 1 to 5 year. There are investments that are designed for that 1 to 5 year stage that are different than the short-term stage. And then when we get into the long term, we talk about the college fund or a new roof, for example. Those are all important. Retirement accounts, again, that's beyond 5 years. So when we meet with an individual, we want to make sure, do they have their assets in the right pockets for the right needs? Occasionally we'll come across somebody that has everything in the long-term pocket, and then when it comes time for something short-term, they have to do some liquidations, and that might not be appropriate. On the other hand, we'll have individuals that might have everything in that short-term pocket. And guess what? Having everything in the short-term pocket doesn't make sense either, because there are investments that are better suited and actually perform better and give a better rate of return. The longer term you can think, and the longer time frame you can build it out. So it's a great little illustration, making sure you have your pockets well balanced in your plan. Okay, let's talk about the 5 basic components of everybody's wealth plan. Well, these are important, whether it's for you or for your parents or your grandparents or whoever it might be in your life. It's so important to recognize there are 5 areas of everybody's plan. So let's talk about the first 5. The 5 are capital accumulation. We're going to talk about risk management. We'll talk about retirement planning. We're going to talk just a bit about taxes and also legacy planning. All right. Okay, let's get started with capital accumulation. Capital accumulation, what is it? Well, it's a fancy word for investing, but it's more than just investing. It's really recognizing your risk levels too. Knowing how you're going to allocate your assets and making sure you're managing and monitoring and rebalancing them on an ongoing basis. So a common question I get a lot is, Tom, tell me, I need to know what the best investment it is to buy. Okay, well, I don't know if you can see this chart. I apologize, it may be a little small, but what it shows you, we call it the jelly bean chart because it has so many colors. It's a jelly bean chart, and each of those boxes represent a different investment category for each year. And it goes back to 2003, and it finishes through just this December of 22. So it's a very up-to-date chart. But it shows where those assets performed, how they performed, ranking them from the top, the very best, to the least performer, which is at the very bottom. So let's use an example here. If you can just glance at the chart, and you can easily see these colors, I'm sure. Look at the red boxes, right? Oh, let's all go red, right? Well, if we went red, let me see if I can use my pen marker here for a moment. The red marker, these are actually the, whoops. These are the actual investments. Let's see if we can get this pen to work again. It was working earlier. All right, let me see if we can get this pen to work. Okay, so if you look at these, the red categories, look how they go they were up there for a few years, then down, back up, back down, down, then back up a little bit, back down, then up some more, then back down, and on it goes. You see, actually that category happens to be international investing. International investing is one of the more volatile, and that's what I mean by zigzaggy. It's more volatile than some of the others. Then if you look at the box that are gray, the darkest gray boxes, those are, some would say, a lot less volatile. Look, they're a lot smoother ride. Some people like to use the analogy of the roller coaster. Well, this is the kiddie ride roller coaster. You notice it goes up and goes down, but it doesn't go up nearly as much or down as nearly as much. It takes out some of that volatility for a little smoother ride, a little better ride, and sometimes a better overall performance. And you can see on that last far right column, it shows the annualized rate of return. The gray box happens to be a diversified portfolio. A diversified portfolio is a little bit of all of the portfolios well managed in a diverse fashion. That actually returned about a 7% return over the last 20 years. Compared to internationals, if yes, you earned some 30% returns a few times, but the reality is you also lost some large percentages if you looked at how volatile that was. So that actually performed about a 6.5% rate of return over 20 years. So how volatile do you want your roller coaster ride to be? That's critically important as you start thinking about this. Okay. All right. So we're talking about risk. Let's talk about risk a little bit. And some of these questions I ask you to think about for yourself. You know, do I want my principal protected? How risk averse are you? For example, I have a hard time tolerating risk. Is that something you might say? Or would you say, no, I can tolerate some short-term risk and some volatility. Oh, I can tolerate moderate loss. I can even lose 10, 20% if I need to on the short-term basis. And then on the far side, hey, I've got a long time out there. I've got 20, 30 years out there until I need the money. So I'm willing to be very, very, I can be willing to take on high volatility and a lot more risk. So asking those kinds of questions kind of lays out now a spectrum for us. The spectrum, if you look at this spectrum, see if I can use my little marker again, see if it works here. Where did it go here? I'm trying to get on my thing. On the far left is what? Low risk. On the far right is high risk, okay? So if you notice, everything in the gray happens to be investment vehicles that are designed to be principal in a principal preservation structure, so that they're designed not to have principal loss, but actually have some upside return. The more you go to the right, which is the more volatile investments, actually have more volatility up and down. They actually have more risk of gain, but they also have a higher risk of loss. You've got to understand that and make sure you can manage that and stomach it. Okay. So one of the things I call out in that same chart is if you look everything in the gray, we kind of call that the savers, and everything over here in the blue area, we call those the investors. So thinking about that as you build out your portfolio, whether you're just starting or you might already have a portfolio established, where are your assets and how are they scattered around in their total spectrum? How do you fit into that? Another thing we'll do, and many investment advisors can do this for you, is there are called risk tolerance questionnaires, where you can literally go through a questionnaire and answer a number of questions. And the way you answer those questions will be scored to determine what your risk score might be. For example, if your risk score, depending upon how you answer these questions, it'll determine, are you a risk taker or are you a risk avoider? So it'll give you a high score if you're risky, but if you want to be very conservative, it'll be usually a low score. And then matching up investment styles and portfolios around those risk scores are very important. So that's a good call out there, and making sure risk. Last thing I'll say about risk. Most people don't know how much risk to take until they've taken too much, and then sadly, it's too late. So why do I say that? I say that because it's so important to get ahead of this. Make sure you know how much risk you're willing to take and understand how much you're willing to lose, because risk and some investments do have loss to them. Last year, in year 22, was the first year in many, many decades where most investment categories actually went down. So some of the most conservative strategies actually lost money last year also. Could you stomach that? Can you stomach it? So if you're young, you probably can. But if you're getting older and older and closer to retirement needs, it becomes less attractive. All right, so let's move on to the next slide. Every investment choice you think about, or even you look at, or want to consider, you need to recognize they have a style about them. And I like this little acronym STYLE, S-T-Y-L-E. Every investment has its own style. So here, I'd like you to follow along with me, and let's walk through these 5 letters and see what they mean. The first is the S, means safety of principal, making sure your assets are making sure you understand how safe is this investment. As far as when it comes to safety of my money, my principal, the amount I put in, how risky is it of me losing any of it or all of it? Making sure you understand that. Now, what do you think T stands for? It stands for tax treatment. Every investment will have different types of tax treatment. Some are tax favorable, some may not be tax favorable. Some might be tax-free, for example, tax-free state taxes and federal taxes. Some might be taxable. Some might be giving a better tax treatment. Those tax treatment strategies and all what they are, you've got to understand what they might be. Some might even be tax deferred. What do you think the Y stands for? It stands for yield and growth potential. What's the yield? How much am I expected to gain? How much am I expected to earn? How much can I grow my assets with this investment? So making sure you understand what that potential yield is. The L stands for liquidity features. Making sure you understand what are the liquidity features. Is it something I could sell very quickly, like a stock or a bond? I can sell it within minutes and have cash and available in about a day or two. Or is it a piece of real estate, for example? Real estate is not very liquid. You usually can't sell it very quickly. It takes time, takes process, and you need to think through the timing of that. So liquidity features is critically important when you look at any investment alternatives. And then the last is the E. What does E stand for? It stands for estate planning impacts. The most important thing is, when you look at investments, you know they have style about them. They have safety of principal, tax treatment, yield, liquidity, but it also, how is it going to impact my estate? How's it going to impact my heirs, my family members that I leave behind? How is it going to impact them? And making sure you title it correctly, make sure you know how it will be owned as far as the needs, and actually how will it be managed through my estate. Will it be in a trust? Will it be owned by myself? Will it be in joint ownership? All those things and those characteristics of an investment will also impact your estate. Okay, so there's a quick little call out. When you look at any investment, make sure you look at the style. All right, let's get into the second category of the 5 basic areas, and that happens to be risk management. Now, I'm not talking about risk management when I'm talking about volatility of the stocks or bonds or whatever the investment you're looking at. I'm talking about your life risks. So the 4 worst things that can happen to anybody is, 1, you become disabled. That's a risk of life. And you need to make sure you're planning and you have planned around that. Also, what happens if I die prematurely? So if you die prematurely, then that's going to impact people that you leave behind, perhaps. So you need to make sure, how am I going to manage that? Or how are they going to manage without me? Is there going to be a shortcome in income for them? Or is there going to be quite a few debts that I leave behind? How are they going to get paid? So those thoughts have to be thought about, and you need to plan for those. Here's another one, property loss. Property loss. Well, if everybody on this call owns a car or has a car, you know you need car insurance, right? It's the law. So in effect, property loss is already built into some of our laws. You have your car, basically you have car insurance. If you have a home, typically you'll have homeowners insurance. If you have life, you need life insurance for life insurance and disability. Those are the first two. But the last one here, the last one may not impact many people in younger ages. It's going to impact those that are aging though. What is that? That's the health. That's the health and long-term care issues. Some people call it, or I call it sometimes, living too long. Geez, I hate to even say that. But the fact is, we'll live longer, and we do live longer every year. And we'll talk about that a little later in the presentation. But making sure you understand those later stages of life do have expenses to them. It's called long-term care expenses that you need to be thinking about. How are you going to manage them? Or who's going to take care of them for you when you age? All right. Those are the four worst things. So let's talk about some of the other things about risk management. One of the call outs I want to mention is disability. People think, oh, I'm not going to get disabled. Oh, I'm not going to die. Well, take a look. And I broke it down by age brackets. That shows you the percentage of those in those age brackets that will experience a disability, whether it's a short-term disability or a long-term disability. The percentages are there. So if you're 35 to 64, there's a 12% chance you're going to have a disability. Well, you can roll the dice, but that tells me about 1 out of every 10 times that person's going to experience a disability. I'm looking at this Zoom webinar now, and we've got 50 people on this call. Approximately, if I did the math, okay, how many people would that mean that's going to be disabled? All right. So you got to do that math and say, wow, that means about what? Five people, okay, are going to experience, maybe 6 are going to experience a disability experience. How comfortable are you in that regard? Can you handle it? Can your families manage through that? Very important. Okay, let's get on to the third area, and that's retirement planning. Retirement planning is, I guess that's our ultimate goal, right? We all want to retire. We all want to enjoy retirement, and we need to think about it ahead of time. So when we're very, very young, it's really, it's kind of hard to even envision retirement. But if you look at your parents or grandparents or the older generations, you recognize retirement planning is critically important. Don't wait too late to start planning. The sooner you plan, the better. When I counsel people in their pre-retirement times, the biggest thing they tell me is, Tom, I wish I started earlier. I wish I started to invest earlier. I wish I had planned better. I wish I had wish. So I'm sharing this with all of everyone on this call, that it's so important to think about these things now. The sooner you can do it, the better. So retirement income strategies. There's all kinds of strategies. Managing your pension, if you're lucky to have one of those anymore. Pensions, there's only 6% of the companies in the entire country that have a pension. They have Social Security options, which we believe we'll have, but healthcare expenses as well. We got to make sure we have healthcare, and just the overall 401k plans, our general investment plans. 401k plans have been around 40 years now, 42 years actually. They started in 1979, 1980. And really, they were created to replace the pensions. But guess what? That means we have the responsibility to save money. If we don't put money in the 401k, it just doesn't happen. You've got to put money in to enjoy it later. So important to put money away for yourself so that you can have it and enjoy it much later. Retirement planning has some other areas that I'd like to talk about. Let me take a sip. One of the things I want to talk about is interest rates and inflation. Let me just show you this chart. This chart goes back, let's say 1958. And I want to show you that blue line. That shows you the treasury yields, the 10-year treasury yields started back in 1958, about 3%. And then it went up and up and up and up and up and up. And then maybe some of you, or maybe if some of you have heard some people talk about the 80s, the early 80s. Wow, we had 15, 16, 17% interest. Well, there it was, folks. There it was. Look how high it was. But since 1981, what has happened on a general trend line now? What has generally happened to interest rates? They have constantly fallen for the last 40 years. So it wasn't until this last year and a half where we've actually seen a spike, an increase in interest rates. See that? The interest rates have gone up. But if you look at the gray line is the net interest, the net after inflation. So when you had high interest rates, you typically have higher inflation. So what happens? Look at these lines down here. You lost money. You're actually losing money. Every time it drops below that line, the money did not generate enough to overcome the inflation factor. So we're dealing in a point in time now, inflation's about 6%. We're no now, well, actually tomorrow we're going to get a release on what the CPI is going to be. We're hoping it's going to get a little lower, but it's looking pretty strong and it's looking very hot. So those inflation rates are looking at 6%. So we need to recognize investments have to earn that or more for us to even break even. Now, I'm not saying to be aggressive and not to be risky with investments, but be aware of the difference between the blue line and the gray line. That's the difference from what you earned and what you actually net really earned is after that inflation factor. Big difference. Here's another a little way I like to illustrate inflation. And some of you might chuckle when you look at these numbers. Look, 1964, if you had a $100,000 CD and the certificate of deposit at a bank, the CD rates were what, 4%. That 4% earned about $4,300. Well, guess what you could do with your interest on that CD in 1964? You could actually buy two, not one, two Ford Mustangs. They were going for about $2,300 back then. You could buy two of them. Then you go 20 years later, interest rate was about 8%. And now you're looking at, oh, I can't because the Mustang has increased in price. That's inflation. It's gone up to $7,000. Now I can only buy one Mustang and maybe 101 full tanks of gas. Well, then again, another 20 years later, interest rates are going to, that same CD is going to only generate me about $2,600. Well, what can I get? I can't even get a Mustang at all. That's $18,000. And on top of that, what can I get? Maybe I can get a top engine kit to help my on my Ford Mustang. But here's the real staggering number. In 2001, interest rates were so low. Now they've come up a little bit, but they were so low, generating so little amount of money. And the Mustang cost $27,000. What could you really get? Well, you could get about 2.5 gallons of gas. That's it. Pretty shocking, huh? All right, next slide. This is, again, I don't want to dwell on it too much, but the power and the importance of recognizing when you invest, and particularly a longer term, inflation has its impacts. If you bought a CD, again, for 10 years, and we started 10 years earning 2%, it actually got you to $12,000. Here we are at the end of the 10 years. Well, with inflation at 3%, and we're just being conservative here, 3% inflation, actually, you lost money, right? You went backwards. So your account is really worth purchasing power of only $9,000, or really, what did we lose? We lost $3,100 in purchasing power on that $10,000 CD. So important. Okay, let's get to tax planning. That's number four, tax planning. And I call out a couple of things in tax planning. Tax avoidance, tax evasion. What's the difference? Is there a difference? Well, there sure is. Tax avoidance is legal. Tax avoidance is good. You can do things to avoid taxation that are legal. However, if you try to not pay your taxes or you do things illegally, that becomes tax evasion. That's a no-no. That puts you in jail. So I don't want you to evade taxes. I want you simply to avoid taxes when you can. So how do you avoid taxes? Well, you look at strategies like tax-free vehicles, tax-deferred vehicles, tax-advantaged vehicles, investment-wise. and how you build your portfolio accordingly can make a big difference in your life. So you want to manage your taxes, never pay more than you need to, and also look to diversify your taxes. Some are tax-free, some are tax-deferred, some are tax-free state, federal, etc. Making sure you manage your overall portfolio. Some people say to me, Tom, well, taxes are so high. They really are high. And, what do I do with this? And I don't, well, then I like to show this next chart. Wow, let's take a look at the history of taxes. This goes back to the early teens of 1900. So this was 100 years ago. Boy, oh boy, look at the tax rates. Let me get out my little pointer again. Here, 60% tax rates back in the teens, and they stayed until about the 20s. And then boom, they dropped down. But boy, right here, what was that? About 1933. Then it stayed above. The highest tax bracket was above 60% all the way until 1980. Okay, 1980, big day. That year, that was some major change to tax reforms. When those tax reforms happened, that's when the tax rates were changed by government. And then they've been pretty steady since 1990. So look, when people say tax rates are high, no, they're not high. They're historically right now, probably the lowest I've seen or will see. For 40 years, they've been this low. Now, will they go higher? They possibly could. In order to pay some of the debt that we have, that might be a reason for increased rates. But all I know is make sure you look at things in perspective. Tax rates historically have been much higher, but we have enjoyed a low period of moderate tax rates, and now you need to plan around that accordingly. Okay, let's keep going. Let's talk about legacy planning. Legacy planning is the last part of everybody's plan that you need to think about, and that is what happens when I pass on. Where is my assets going to go? Where are my parents' assets going to go? Where are my grandparents' assets are going to go? So it's so important to recognize, do you have a plan together? Have you thought about it? And how do you get it to the next generation the most effective way? Do you have wills in place? Do you have trust documents in place? Do I want to donate money to a charity? All those things need to be talked about and managed. Just don't pass over it. It happens. Death is still hovering at 100%, or I say the mortality rate is still hovering at 100%. We all know we're going to die. They say two things in taxes and death are the two assurances in life, right? So we need to make sure we plan out and think through that accordingly. Let's talk about the life expectancy, because I'd like to show this chart. A lot of people say, where did we come from? Well, look at this. This is quite amazing. This goes back to the 1800s. In the 1800s, life expectancy, as someone being born in the 1860s, your life expectancy was about in your 30s. How about that? In your 40s, maybe. And it stayed there until we actually got here to 1880. Okay. And then some improvements of diet, improvements of medicines and so forth. That helped get us going. Then we had a dip. What do you think that dip's from? It's from the wars and some of the plagues. So we had the dip again. But again, life expectancy overall for a brand new birth was still in the low 50s. But then finally, from the 1930s on, we've seen a gradual increase all the way up to now it's 78 to 80 on average on a brand new newborn. Sometimes, depending upon other statistics, and you can really get into the details of regions of the country, family, genetics, I mean, all kinds of different nuances. We can even see life expectancies in the 80s, 90s, even in the early low hundreds. But so important to recognize life expectancy is on a growth trend, and I believe it's going to continue on this trend with new improvements in medicine. So recognize we will live longer. So that leads me to my last area I want to talk about is how do we measure up? Well, how do we measure up? We measure up by looking at what stage of life you're in, okay? Let's talk about the 3 stages of life. I call it the 30-30-30 stage, and some of you have heard me say this, but here's how it goes. For the first 30 years of your life, from 0 to 30, you're in your learning stage. You're learning who you are, what you're going to be, what your skill sets are going to be. You're getting your education. You're building out your whole employment strategy of what you might be doing in your life, etc. That's the first 30 years of your life. But then that next 30 years of your life, it's from 30 to 60. I call those your earning years. Those are what you're earning. You're earning money during those earning years. It's what you do with that money that's going to make a difference in the last 30 years of your life. So first 30 is your learning. Next 30 is your earning years. You're actually earning money. Well, from 60 to 90 is the last 30 years of your life. The last 30 years. I call that the burning stage, because you're burning up, you're using up, you're enjoying the assets you've set aside and invested. So what do I say? If you haven't set aside enough, you're not going to be able to enjoy very much when you get to that last stage. So the more you can set aside, the better off you're going to be. And making sure you plan for that. Plan for life events. Do the reality check-in in life. What are those things that could happen during my life, and making sure I plan around those for my life, and making sure you have assets set aside. I'm asked this often, Tom, can I be a millionaire, or is it hard to become a millionaire? And I can tell you the answer. It's not hard at all. It's not hard at all. I would venture to say, and this is a general statement, most people on this call could easily become a millionaire. The question is, how many are willing to take the steps to do it? How many are willing to commit to the steps that it takes? Because it takes steps, it takes commitment, discipline, and regularity of investing on an ongoing basis. So if you have long-term goals, that means long-term, right? So you need to set aside things during a long-term process. So the last is 401ks, and making sure you set aside your money in your retirement accounts at your current employer. If you have one, you want to be setting money aside. If you don't have an employer that has a 401k, make sure you're setting a money aside for yourself in an IRA. And there's lots of different IRA options. I don't want to take the time to go over those tonight, but make sure you're setting money aside during those balances, or during those times, because the more you set aside, the better you'll enjoy life later. So let me give you this I love this chart. It comes from Fidelity. It estimates someone's retirement accounts, what they should look like at their different ages. All right, so if you're age 30, they say you should probably have about 1 times your income in your 401k. Wow. How many do have that now? Some of us might be under 30. Well, guess what? When you get 30, I hope you have at least 1 times your income. Some of us that are older than 30 that might be on this call, you've got to take a good look at the situation here. How am I? How far along am I? Am I on track? And as you age, you can see 35, 40, 45. Boy, when you get to 50, you need 6 times your income. 6 times your income. And then 60 and 7, up to 67 is the normal retirement age now. You need about 10 times your income. So 10 times your income at that point in time is important to have, because that's going to be the asset that you're going to need to generate enough income added to your Social Security that will provide a very comfortable retirement. I'm not saying a rich retirement, I'm saying a comfortable retirement. So very, very important. This is just a general rule of thumb. Your situation and your numbers will be different because it'll be based on your own situation. But this is a general rule of thumb, a little litmus test of where am I and am I on track? Good stuff. Okay, let's talk about some takeaways. These are just a wrap up of what I've said before, and that is how many have started their opium plan? Have you organized, set your objectives? Have you started to plan, start to project? Are you monitoring and managing your plan? Also, have you thought about all 5 of those areas, right? Investments, risk management, retirement planning, tax planning, and estate planning. Do you know your risk tolerance level? Making sure you know how much risk to take. And then compare your investments options using the STYLE acronym. Also managing your life risks, making sure you think through those risks and you plan accordingly. And then lastly is start planning, and start planning now. So, so important. The sooner you do it, the better off you're going to be for the long-term life that you'll have. All right, so I'm done. There we go.